All right, guys, welcome back for another video. In today's video, I want to talk about Arthur Hayes and some of the material he's written. If you guys aren't familiar with Arthur Hayes, uh, you know he's the former CEO of BitMEX, which was a lot more front and center in the crypto space 2 years ago than he is now. After recent run-ins with the law and regulatory authorities, but he's an absolute genius, still active, publishing material. I would read everything he's ever written. He's just an absolute genius. But I want to talk about this article in particular titled Pumping Iron. Don't let this image distract you. It's a very well thought out piece documenting his portfolio strategy. And just to sum up his whole portfolio strategy without reading the whole article, he advocates for a portfolio construction that on one end of the portfolio is long crypto, so you could say 50% long crypto, and on the other end, 50% long interest rate volatility, meaning option contracts capturing the interest rate volatility, but also generally being long on government bond yields on that portion of the portfolio. And the reason being is, in that sense, you have two directly inversely correlated portions of the portfolio. And it correlates to the fact that central banks, at this point in the market at least, remember this is March 2021, inflation had been running hot, and central bankers were basically left with two decisions. They could let inflation run, in which case the crypto portion of that portfolio construction would have massive returns, or they could raise interest rates in real terms above the rate of inflation, and in that case the interest rate volatility would increase dramatically. And that's kind of illustrated by this chart right here. So if you look at this chart, basically what it's showing, the best way to summarize this chart is that as you raise interest rates, the volatility of the interest rates increases dramatically in a way that's divergent from if you say we're to lower interest rates, the volatility would also be lower in the volatility as they fluctuate. Put another way, as you raise interest rates, the interest rates or yields in the market are constantly going up and down at an increasing rate. And as you push interest rates higher, the volatility also increases. Again, a little bit of a nuanced topic, but something very important to understand. I'll see if I can find another. Yeah, here's another image. This is just the Bloomberg index. It's called the MOVE index. It basically captures interest rate volatility. So you can see here that that's exactly what's happened as you raise interest rates, right? The Fed embarks on its interest rate rising program here, and volatility in the interest rate market increases up to extremes. Now, just going back to the article, I just want to go through some of the better parts of the article a little bit briefly. He goes through a lot of the history behind different crises and kind of talks about his strategy. And he also goes through different asset classes. So here you have, he talks about stocks, and he talks about some of the issues with stocks in an inflationary environment. I mean, you got to remember that in an inflationary environment, stocks or equities are constantly going to suffer for a number of reasons. One reason being that anytime a CPI print comes up, high, that the market's going to sell off. But there's a lot of other issues as well. So basically, anytime you have an issue with inflation, you have an issue with the cash flow or the way that equities are valued. So because equities are valued by discounted cash flow analysis, any disruption in the monetary medium will disrupt that valuation system. And going further than that, it also puts pressure on corporate margins. So as inflation increases, a lot of these margins operate on, a couple cents on the dollar. So their margins are already very small. They're very lean in that sense. And when you have inflationary pressures increasing the cost of goods and services, it can cause a dramatic impact on corporation's ability to be profitable. That's why I think, not only as inflation rises will you see the issue of sovereign default, governments going insolvent, but you also see some of these pretty big corporations that have reached monopoly status kind of get into trouble even despite their monopolies. So just kind of revisiting that idea, we can go to this graph right here, and what this basically shows is you can see that it shows CPI mapped over corporate earnings, and you can see here basically if you look at the areas where CPI peaked, corporate earnings, are typically inversely correlated to those peaks. So as you get a high CPI print, corporate earnings are, generally low relative to previous times, and vice versa as well. When CPI is low, equities do well. And that's for a number of reasons, as we just mentioned. But going back to the article, he also goes through, talks about real estate, and the benefits of real estate. I mean, real estate is, in an inflationary environment, is a decent investment because there is some degree of scarcity to real estate. There's only so many houses. But, if you think about it objectively, real estate it doesn't get more valuable in real terms, right? Real estate generally, it gets older. Your home gets older, it needs repairs. It is a deteriorating asset in real terms. Of course, in nominal terms, it'll go up in nominal value. But it's just something to keep in mind. Not really a great investment strategy. And I think some of the monetary premium not some of the monetary premium, but the huge major monetary premium that you see in housing is reflective of, how crazy the system is. And here he's kind of moving to gold. Gold is all right. Gold is basically, it's essentially competing with Bitcoin to do the same thing that Bitcoin's doing, but Bitcoin is doing it better, or has perfected the things that gold used to be a use case for as money. But currently, I think really the one thing gold has going for it is the precedent of major institutions that are older, that have a history of turning to gold in times of crisis, and they may turn to gold in those times of crisis, should they come. And then he goes down to talk about Bitcoin, of course, basically talking how Bitcoin ruins the 60-40 portfolio. If you're not familiar with that, 60% equities, 40% bonds. That was the traditional portfolio, because these asset classes used to be inversely correlated. But now in the new environment, they're no longer inversely correlated. They're actually positively correlated, so that correlation has changed. You can see that by bonds getting wrecked as equities get wrecked. So, and then he goes on to talk about the rising rates environment. Basically, central banks are forced to raise rates to a territory where real interest rates are positive, and that causes basically a total global debt unwind. So, he makes the suggestion that the government is trying to incentivize demand in the bond market, not trying to avoid having to step in and be the buyer of last resort. But, that's, it's kind of difficult to orchestrate that. And here he kind of talks about his, how to go long interest rates. Again, it sounds very easy, but, in order to capture interest rate volatility, you need to know how to, engage in option contracts. So basically, you have a situation here where he's constructing a portfolio where, essentially no matter what happens, right, the portfolio is going to make money because he's created, both tail ends that are inversely correlated. Going back to the date this article was published, March 2021, that was right around the peak of the cycle. Coinbase had just about announced its IPO, and that was really the peak in April 2021. Let's see, find the chart right here. So, yeah, this article was published March 2021, right about there. And then you had the Coinbase IPO right here. And, from that point, a lot of people are very bullish, right? We didn't have the rising interest rate era. We don't know. At that point, you have to keep in mind that we don't know how the central bank was going to react. The price could have just continued going, at which point you want a long portion of the portfolio to be exposed to crypto. But also, he kind of observed the fact that, maybe it wasn't ideal to be, overly exposed at these levels. Maybe you want to be hedged in some way. And another thing to illustrate that point, that really was the peak when Coinbase did their IPO, is by looking at the RSI. If you look at the RSI, basically, you have this type of situation where you can see how the RSI, hit its peak distribution phase right here. And this is not really a peak. And one of the reasons why this can be confusing, and another way to think about it is, if you think about the fact that if you have currency debasement, which we've had, pretty dramatically since March 2020, if you have currency debasement, the unit of measurement is breaking down. So if you were to measure Bitcoin against, the US dollar that wasn't inflating, this may have been a lower high. So some of this increase is, so while yes, it did run above the old high, if you look at the RSI, this is just a lower high in the RSI. Another way to put it in perspective is to, zoom out a little bit, look at the former all-time high, and you can see here that, that generally your market peaks come into this critical zone. And sort of your, you wouldn't call this a cycle peak right here, even though it did get much higher than this. It's just a way to look at it. And it also puts a little bit in perspective, right? Because if you were to mark it from peak to trough, right, this bear market was essentially, you got December to December, so 12 months. And a lot of people are describing this as the cycle peak. But if you really graph it from that Coinbase IPO, when things started to break down from this RSI peak right here, and really that's your top right there. And let's see. So really, from the RSI perspective, the cycle's actually been in a more prolonged bear market than the previous 2018 bear market. Again, that might be a little bit of a controversial opinion. People may not agree with that, but it's a different perspective. And I think it would generally line up with the type of capitulation you're seeing in the market right now. Because not only do you need fast down movements, right, but you need a period of generally prolonged time for that to happen. So, whereas this quick, sudden move down in May of 2021 may have, obviously this created a lot of liquidations and forced a lot of people out of the market, but probably not a whole lot of capitulation, right? Just because the time component wasn't really there. But when you have a long, protracted, drawn-out bear market, that, of course, that's when you really run into those capitulation type. People just lose hope, they lose faith, they don't have enough conviction, and they sell at the lows. But going back to the article about Arthur and kind of his take on the kind of the binary approach that central bankers have is, again, there's really two different options, right? Bankers can keep raising rates, or they can, print money. It's really, of course, there are more different paths that could be taken, more nuance to it. But at the end of the day, those are really the two distinct binary options that are at play for the central bankers. And yeah, it's very difficult to say if one would be chosen over the other. Um, it's tempting to think that, you could take what they say at face value and that you could know and anticipate what will happen in the future based on their statements. But if you just back test that and look historically, you can see that some of the things that they have said and some of the things they've indicated is not reliable. And we can illustrate that with, let's see if I can find this chart. All right, here we go. So the Fed balance sheet in USD. So this is showing you that, this is the projections on what the Fed had previously projected to run off their balance sheet, and this is what actually happened. So here, you have QE, and then you enter a period of quantitative tightening, and this is the projection. This is what the Fed indicated they would roll off their balance sheet. But then in reality, you get this QE. And then here, you get quantitative tightening, projection, reality. Projection, reality. Projection, reality. Projection, reality. And now you have another projection here. And everybody just kind of assumes that that projection will be a reality without, looking at the past and kind of realizing that, yeah, maybe it won't be a reality. Maybe it will. It's always a possibility. But, I mean, look at this. This is pretty heavy odds that the projections won't line up with reality, right? The Fed, before they reach their projected target, will encounter some type of break in the credit markets that will cause them to pivot and intervene in the credit markets. Obviously that's probably the most likely outcome. Anyway, I do hope you guys like this content. Please just leave a like on the video, subscribe to the channel, and I'll catch you guys in the next upload.